In this video, traders, I want to talk about when should you review your trade. Stay tuned. Hi guys, warm welcome to you. So when should you review your trade? So what do I mean by this? When you're in a trade and the trade is going your way, people tend to think of it as a kind of a binary outcome, right? Hit your target, hit your stop. But in the real world, guys, that's not always the case, is it? You know it, I know it. The market is dynamic, it's living, breathing, has a kind of pulse to it. Expands volatility, contracts volatility, moves to fresh highs, moves to fresh lows, backfills, congests. And it often does that when you're in the middle of a trade, because that's just the way the market operates. If you're trading on a time frame where, even a smaller time frame, we know intraday we get the kind of volatility open and then kind of contraction of volume of volatility at lunchtime and a slight expansion into the evening. Swing trading, you know this more. But if you're in a trade and this trade market starts to do something a little bit different to the reason you got in, you have to do something about that. So how would you operate? How does this work? So really we kind of think, oh, it's a target or stop. And I admire you if you're sticking to your rules. I admire you if you said, right, it's my target or it's my stop, and that's that. That's absolutely fine. But the danger you have is that, let's say you've taken a momentum ignition type trade, fine, it's going in your direction. You've slightly misjudged the first profit target, just slightly misjudged it. Happens, right? It's always going to happen. So what do you do then? Now, if you're being ultra strict with your trade, like, well, it's profit target or stop, I'm not allowed to meddle with a trade until this, and that's good. But here's something else you can add into it. You can say to yourself, hey, listen, I have various areas where I'm allowed to review the trade. And that normally is a time period. So I'm going to use swing trading as an example, because it's an easy way to look at it. Let's say you're in a trade, okay? Profit target's there, price has moved up, hasn't hit it yet, but it's not far off. It's not a million miles away. Then the price just starts to stagnate. It was a nice drive higher. It was a nice flag and drive higher, and it starts to stagnate. So what do you do then? Because really what you're doing now is you've almost skewed the risk reward in some respects, because you're trying to make an extra 1 and you're risking maybe 5 for it to go back, and you wouldn't take that trade initially. Now, it's not as simple as that, because of course the trade is always going in your favor, and by the time it's about to hit the target, the risk reward is ultimately skewed. But at some point, you've kind of got to look at it and say, hey, conditions have changed here. This wasn't the conditions, or these aren't the conditions, should I say, that were present when I took the trade initially. They have changed. The market is dynamic. And so do I need to do anything with this trade? And so having a time period where, let's say you hold the trade for 5 days, for example, different time frames how you hold stuff for, but let's say you've held it for 5 days, and after those 5 days, you had the permission to do something with the trade and review the trade. Now, why do you set a time period on this? Well, it stops you from meddling with the trade every hour, every day. You're like, should I do something? Should I do something? It's like, no, I'm going to use the rigidity of the rule system that I've got and keep disciplined and not meddle with stuff by saying, hey, I'm going to hold on to this trade. I'm not going to touch it until target, stop loss, or 5 days. Okay, so that protects you if it gets up there and it almost gets there 3 days forward, sits there, does nothing for a couple of days. You're like, right, 5 days, I can review it. It helps the chimp as well. We talk about a chimp a lot in Traders Mastermind, guys, and talked about loads on here. That little voice that's saying, oh, go on, you can take it, it's close. Don't take it because your rules. Go on, take it, you're going to lose all that profit. Take it, you've got this internal dialogue going on. It helps soothe that, because what you do is you basically say, right, shush, for one more day, I can review it. And then you can do what you like, and there'll be probably a few options. Scale out of the trade, move the stop up, close the trade completely, add to it if you're kind of that's the way you're wanting to play the game. But the point is, you're still using a little bit of patience. You're still letting the market mature, or the trade mature into the target you want, but you're adding this extra layer in there that says, hey, after this period of time, I'm allowed to review and adjust if needed. So it soothes the chimp. It also allows you to adjust to the dynamic changing conditions of the market, which they're changing all the time. And you know this as well. You know you've been in a trade and it goes nearly your favor and just sits there and stagnates. You're still treating that like a momentum type market, because that's the reason you went in. Now, it might be that you're happy to sit there, but make the decision proactively don't make that the default decision. Say, hey, my decision now is to wait until day 5 or target or stop. Fine. Day 5 comes along. Now you're proactively saying, hey, I'm going to hold this now for another 5 days, or I'm going to hold this now until the target, or I'm going to ratchet up my stop, or I'm going to close off, whatever it is. You're making a proactive decision to play again, if you like, to keep going, to roll it over and trade for another 5 days, or 15 minutes, or 50 days, whatever time period you're trading. I think that's a really good way of just calming everything down a bit, allowing for the market to change condition, and something that you don't feel like you're breaking rules, because otherwise you're thinking, well, what do? Do I, if it's nearly on my target, do I allow myself to cut it? Do I bring my stop out? How do I do it within my rules? Well, now you've got an easy way of doing it. It's okay, rules are that you hold it until this period of time, then I review, and then you can cycle again and cycle again and cycle again. And the good thing about that, finally, guys, is that you start to document and get good, or see what you're good at. If you're good at reviewing it correctly and you have a good history of doing it right, for want of a better word, that's profitable, moving the targets up, or moving the stop up, or taking half off, then you can keep that. If you find that that's not the right thing to do, then you can work on that exclusively as well. So it gives you something else to work on and improve. So something to consider if you find yourself almost hitting the target, or the market starts to do nothing once you're in the trade. Give yourself in the plan, don't do it on the fly, in the plan, X number of days, X number of minutes, when you can review the trade, and give yourself in the plan again the 3 or 4 options that you're allowed to decide. Because you're the CEO of your trading business. You need to make those decisions. You're not passively letting the market choose for you. You decide, I'm holding this and see what happens over another 5 days after this, or I'm cutting it, or whatever the other things we talked about. You know the options that are available. You pick the ones that are right for you. Add them to the trading plan. Try it out. Let me know how you get on. Take care, guys. Bye-bye.